Hi, this is Jeff Camardi, your Wealth Doctor, the Wealth Doctor, with your crash course on what you must know about estate taxes. Now, estate taxes, not with an E, right? Estate taxes, not state taxes, are taxes that are imposed on wealth at death. So for taxable estates, for federal purposes, the federal estate tax takes about half of the taxable wealth, 40%, under existing law. Plus 17 states, plus the District of Columbia, have their own estate tax, which is on top of any federal tax. There are some adjustments and deductions and so forth, but it's more tax. It's not like it disappears entirely in many states. Each person can pass under federal law, under existing law, about $13 million tax-free at death or during life, which we'll talk about a little bit at the end here, until the end of 2025, when it gets cut in half to about $6.5 million under existing law. Married folks can double that amount, about $26 million until the end of 25, $13 million or so thereafter, adjusted for inflation. And that's called the federal transfer tax, or what most people think of as the estate tax exemption, because that first $13 million per person until 25 is exempt from tax, and then the tax applies to anything over that. Some state estate taxes can kick in at much lower levels. Like, for instance, Massachusetts, the exemption amount is $2 million, so everything over $2 million is subject to estate tax. And also watch out for states that have so-called estate tax cliffs, like New York, my home state, but by no means alone in this. And the estate tax cliff is where under the tax-free amount, there's no estate tax. Once you kick over that threshold or that cliff, then not only is everything over the threshold subject to tax, which is where the federal estate tax works, but everything under it too. So if you get like a penny over, just to use a simple and dramatic example, say if the exemption amount is, I'll say $4 million, and I should look it up because it varies by state, but it's $4 million, you can pass up to $4 million free of any estate taxes. If you're $4 million and a penny, and then the cliff is at $4 million, then the entire $4 million and 1 cent is subject to estate taxes. That can burn really bad, and if you were a resident of a state with a estate tax cliff, you want to do some really fancy planning to avoid that, because the payoff is huge. Also remember, and this is really important, and a point that I think is very, very frequently missed by a lot of otherwise smart estate planners, lawyers, CPAs, and financial planners and advisors, and that's that this is not a static situation. It's not what you're worth now. There are two big variables. It's going to be what you're worth, when the reaper comes a calling, if you will, and also what the estate tax law says at that point in time. So if you're, say, gee whiz, under existing law, I'm worth about $6 million, my spouse is worth about $6 million, that's $12 million. Even if it goes to half at the end of 25, we can pass a total of $13 million together. It's 6.5 times 2, because we're married. Then we don't have to worry about estate taxes. But there's two critical errors in that thinking. Number one is that it's probably going to grow some, with investments and other stuff and your retirement income. Maybe you'll spend it all and get to death, with the tank dry. But, most people, not all, but most are more prudent in that, and they're careful, and they want to see their net worth grow and so forth. So if it grows beyond the tax-free amount, you're going to have estate taxes. And the second thing is the law is very likely to change. And in my view, the level of wealth that estate taxes will be imposed on will be much, much lower. And there's a lot of reasons, primarily because the federal government is going deeply, deeply, deeply in debt. And there aren't that many people in the country, there aren't that many voters that have the kinds of net worths that they would are remotely exposed to estate tax. The number of millionaires in this country is relatively some very small percentage. So it's kind of a soft target. There's a lot of money there, and their votes don't really add up to very much. So I think that both tax rates will go up along with your wealth. Prudent planning now can solve that potential problem. I'm not going to get a whole lot into, because this is such a complicated area, and these crash courses are really designed to be 5 and 8 minutes. But you should look at some of my longer classes and courses. But it's, the other thing that you must know is that the federal estate tax is really the one half of the so-called transfer tax. It's a unified transfer tax where you have both gift taxes and estate taxes. And the critical thing is that if you give away under existing law now, 13 million times 2, 26 million for a married couple, and get that out of your estate, whatever grows to beyond, and you make a taxable gift and use up that same exemption. So that 26 million either works for estate or gift, or some combination thereof, but it's limited to 26 million for both. But you get it out of your taxable estate. Now whatever it grows to is free of the estate tax because it's not in your estate, and that's really important. It's just one of many concepts that you need in order to have a very effective estate tax avoidance plan, because obviously you give it away, but I'm still here. I want to use it. I want to enjoy my retirement. I've worked my whole life for this, whatever. And there are ways to do that if you have sophisticated counsel in building your estate plan. But again, that's too much really for this crash course. Watch my other classes and courses to get more detail on this and other really, really important wealth training and topics. Remember to like and subscribe. And you'll have full access as a subscriber to all of my large catalog of wealth education classes and materials and other stuff. Thanks for watching. This is Dr. Jeff Camarda, the Wealth Doctor. Until next time, bye-bye.